How a Fed intervention in Japanese yen impacts Bitcoin. On January 23, 2026, the New York Federal Reserve conducted rate checks on the dollar-yen exchange rate, which market participants and analysts interpreted as an open signal of potential U.S. intervention to support the yen. This move came amid concerns over the yen's rapid depreciation, and it was coordinated in tone with Japanese authorities, who have expressed worries about excessive volatility. U.S. interventions in foreign exchange markets are rare. The last U.S. intervention specifically involving the yen occurred in March 2011, when the U.S. joined a coordinated G7 effort to sell yen, to weaken it post-earthquake. Since 1996, the U.S. has only intervened 3 times in total, with no interventions or similar open signals reported in the interim for the yen. This is often a precursor to actual intervention and serves as a verbal warning to markets to curb excessive volatility or speculation. If escalated to full intervention, it would typically involve coordinated action between the U.S., via the Fed, acting on behalf of the Treasury, and Japanese authorities, Bank of Japan or Ministry of Finance. How would an intervention look like? Selling U.S. dollars to buy the Japanese yen. To strengthen the yen, which has been depreciating rapidly, authorities would flood the market with dollar sales, directly purchasing yen in spot or forward FX markets. This could happen suddenly during thin trading hours, during Asian or early U.S. sessions, to maximize impact and surprise speculators. How intervention works. Interventions are executed through major commercial banks like J.P. Morgan, Citigroup and other banks as agents. The U.S. might draw from its Exchange Stabilization Fund, ESF, while Japan uses its foreign reserves. Historically, such moves can involve billions in trades, like Japan's 2024 unilateral interventions totaling over $60 billion. What's the impact on Bitcoin? From a liquidity perspective, a US-backed yen intervention could have a mixed, dual-phase impact on Bitcoin, potentially creating short-term headwinds but longer-term tailwinds, depending on how it unfolds. Short-term liquidity crunch risk. A sudden yen strengthening could trigger an unwind of the massive yen carry trade, estimated at trillions in notional value, where investors borrow low-yield yen to fund higher-risk assets like Bitcoin. If the yen rallies sharply, like 1–2% in a day, borrowers face margin calls, forcing sales of Bitcoin and other risk assets, leading to a temporary liquidity drain and price dip, similar to Bitcoin's brief drop below $90,000 in early 2026 amid yen volatility. This risk-off phase might exacerbate Bitcoin liquidations, as seen in past FX shocks. Longer-term liquidity boost. On the bullish side, if the Fed supports the intervention by effectively printing dollars, creating new bank reserves to sell against yen purchases, it acts as stealth quantitative easing, QE. This expands global dollar liquidity, weakening the dollar and encouraging risk-taking. Bitcoin, as a liquidity sponge, historically rallies during such periods, like the 2020 to 2021 QE boom. A weaker USD also indirectly supports Bitcoin by making it more attractive to non-USD holders. Overall, the net effect hinges on execution. An orderly intervention favors Bitcoin via added liquidity, while a chaotic one could cause a flush before recovery. Watch dollar-yen levels, below 155 to 160, as a stability signal, and Fed balance sheet data for clues. Thank you for watching. Click the like and subscribe buttons to stay informed.